taxes. That one word can send a shiver down the spine of even the most confident entrepreneur. You built something from nothing. You took the risks. You put in the hours. Now, a single missed form or a simple accounting error can feel like a punishment for your success, costing you thousands of dollars you rightfully earned. It's a source of constant, low-grade anxiety for so many business owners. They worry about an audit. They worry about penalties. They worry they are paying way too much, but they have no idea what they are missing. It feels complicated, opaque, designed to trip you up. This is a common feeling, but it is not a life sentence. Let's be clear. Imagine Sarah, a talented graphic designer who recently started her own freelance business. She's brilliant at her craft, but new to the world of finance. To buy a new software subscription for a client project, she uses her personal credit card. Later, when she needs groceries, she might use that same card. Client payments go directly into her personal checking account. It's the same account she uses to pay her rent, and the same one that pays her Netflix subscription. In her mind, it's all her money. So what's the big deal? She thinks she can just sort it out at year-end with a shoebox full of receipts and a giant spreadsheet. Here's what goes wrong. By commingling her funds, she creates an accounting nightmare that's nearly impossible to untangle. Her business income and personal spending become completely blurred. That makes it incredibly difficult to know her business's true profitability. When tax time comes, she'll inevitably miss legitimate business deductions because they're buried among personal transactions. Worse, if she ever faces an audit, this lack of separation is a massive red flag. The correction is surprisingly simple. First thing you should do: open a dedicated business checking account and get a business credit card. This creates a clean, impenetrable wall between your personal finances and your business operations. All business income, every single dollar from a client, goes into the business account. Let's look at Tom. Tom runs a small but successful landscaping business. He is constantly on the go, buying small items throughout the day. A bag of fertilizer here, a pair of work gloves there, a coffee for a client meeting. He gets a receipt for each purchase, but he sees them as insignificant. He thinks it's only $5, who cares? So he shoves these small receipts into the glove compartment of his truck. He also tucks them into a random box in his office, promising he'll get to them later. Months go by and later never comes. These small expenses add up to a substantial amount over a year. A $5 expense every other day is nearly $1,000 in missed deductions annually. By not tracking them, Tom is artificially inflating his business's profit in the eyes of the tax authorities. That means his taxable income is higher, and he pays more taxes than necessary. He's literally giving away hard-earned money because he lacks a system. The fix is to embrace technology and create a simple weekly habit. You don't need a complex accounting suite. A simple spreadsheet, a user-friendly expense tracking app on your phone. Designate a time each week, say Friday afternoon, for 15 minutes to go through expenses. Use your phone to scan every receipt the moment you get it. Many apps will even auto-populate the data for you. Think of every receipt as a coupon that reduces your tax bill. Record every single expense. Meet Mira, a talented web developer who is deeply focused on delivering amazing work for her clients. She loves coding. She is deeply focused on delivering amazing work for her clients, but she detests administrative tasks. She knows there are tax deadlines, quarterly estimated tax payments, annual filing dates. She doesn't write them down. She assumes she will just remember them or see a reminder somewhere. One day, a stern-looking envelope arrives in the mail. It's a penalty notice from the tax authority for a missed estimated tax payment. The consequences of forgetting tax deadlines are immediate and painful. The government does not accept "I forgot" as a valid excuse. Missing a deadline results in automatic penalties and interest charges that begin accumulating from the very first day. These charges can quickly snowball into a significant financial burden. Beyond the monetary cost, there is stress and anxiety. The correction here is to treat tax deadlines with the same seriousness as a major client deadline. Put it in every calendar you use: phone, computer, and your wall calendar. Set one for a week before and another for 2 days before. Most tax authorities allow you to schedule future payments online. This set it and forget it approach removes the risk of forgetfulness. Mike runs a growing marketing agency, needs extra help with a big project. He brings on a skilled writer, tells her she is an independent contractor, pays her a flat fee per project. He requires her to work from his office during specific hours. She uses his equipment. He closely directs every aspect of her work, just as he would with an employee. He doesn't use a formal contract, relies on a verbal agreement. This is a ticking time bomb. Tax authorities have strict rules for determining employee versus contractor. The key factor is control. If you control what work is done and how it is done, that person is likely an employee, regardless of what you call them. Reclassification during an audit or complaint can cause devastating financial fallout. Mike could be held liable for years of back payroll taxes, both his share and the employees, plus steep penalties and interest. Understand the rules, use clear formal agreements. The IRS and tax agencies provide guidelines, often a checklist. These focus on behavioral control, financial control, and the nature of the relationship. When in doubt, consult an accountant or labor attorney. A small professional fee up front is far cheaper than years of back taxes and fines. Always use a written contract that clearly outlines the scope of work, payment terms, and the nature of the business relationship. A proper contractor agreement will state the contractor is responsible for their own taxes, uses their own tools, and controls their own schedule. This document is your first line of defense. It protects you legally, clarifies expectations, and leads to a healthier, more professional relationship. Don't take shortcuts with people. It's one of the riskiest parts of owning a business. Lena operates a thriving e-commerce store from a dedicated room in her apartment. She sells handmade jewelry online. She diligently tracks direct costs like beads and shipping boxes. She thinks claiming a home office deduction is too complicated and risky. She pays for software subscriptions, website host, email marketing service, photo editing software, but she forgets to categorize them as business expenses. She files taxes based only on her most obvious costs, thinking it's conservative. The problem is, she's voluntarily overpaying her taxes. Every legitimate deduction you miss increases taxable income and your tax bill. She's leaving money on the table, money that could be reinvested, paid as salary, or saved. The home office deduction can cover part of rent, utilities, internet. Forgetting to claim these makes profit look lower than it should. The fix: be proactive and systematic about identifying and tracking deductions. Start by making a comprehensive list of common deductions for your industry. Do a quick online search for e-commerce tax deductions, or ask an accountant for a checklist. Include items like business use of your car, professional development courses, bank fees, the home office deduction. The home office rules have a simplified method based on square footage. Once you have the master list, integrate it into weekly expense tracking. Create matching categories in your spreadsheet or app. Review bank and credit card statements and quickly categorize each expense. For the home office, calculate square footage once. For shared bills like internet, determine a reasonable business use percentage. Be methodical, and you can confidently claim every deduction you're entitled to. Let's consider Daniel, a freelance consultant. He communicates with clients primarily through email. He sends invoices, he receives confirmation of payments, he keeps big paper receipts, he throws away small receipts. At year end, he cleans out files. He deletes old email threads. He tosses folders of paper to reduce clutter. He assumes after filing, he no longer needs supporting documentation. He has no systematic backup for his financial records. Tax authorities can audit returns for at least 3 years. Sometimes audits go longer. If Daniel is audited and cannot produce documentation to support reported income and claim deductions, those deductions can be disallowed. He would owe back taxes on the disallowed amounts, plus penalties and interest. Without proof, his tax return is just unsubstantiated claims. He is essentially defenseless in an audit. The fix: implement a robust, simple digital record-keeping system. The shoebox of receipts is outdated and dangerous. New mantra: scan everything. Save scans to the cloud. For every paper receipt, scan it. For every digital receipt, save it as a PDF. For every invoice and bank statement, save them as PDFs. Store all digital documents in a dedicated cloud folder system. Organize by year with folders for income, expense receipts, bank statements, contracts, and tax filings. Cloud storage is secure, accessible, and protected from local disasters. Keep tax-related records for at least 3 years. Many accountants recommend 7. With digital storage, this is effortless. Raj is a resourceful and self-reliant entrepreneur who runs a small IT support company. He believes in saving money wherever possible, so he decides to do his own business taxes using popular tax software. He works his way through the program's questions, but when he comes across a section about asset depreciation or a form he doesn't recognize, he gets confused. Rather than seeking help, he makes his best guess or skips the line altogether, hoping it doesn't matter. He submits his return, proud of the money he saved by not hiring an accountant, completely unaware of the costly errors and missed savings opportunities hidden in his filing. The danger of a purely DIY approach, especially as your business grows more complex, is the high potential for unseen errors. Tax software is a powerful tool, but is not a substitute for professional judgment. It can't ask you probing questions to uncover deductions. A simple mistake, like choosing the wrong business classification, can trigger an audit. Or misinterpreting a question about inventory can cause you to overpay by thousands of dollars. The money Raj thought he saved on an accountant's fee could be dwarfed by a single mistake. The solution is to adopt a hybrid approach. Use software for the heavy lifting, but invest in a professional review. You can still do the bulk of the data entry and organization yourself using tax software. However, before you click submit, pay for 1 or 2 hours of a qualified tax professional's time to review your return. Think of this as hiring a pilot to check your flight plan before a long journey. They can spot red flags, identify missed deductions, correct misclassifications, and offer strategic advice. We have walked through 8 common but costly tax mistakes, from mixing personal and business funds to flying solo on tax preparation. We have seen how small oversights can lead to big financial headaches, missed savings, and unnecessary stress. Each error stems from the same root cause: the lack of a simple, consistent system. The good news? Each problem has a simple, actionable fix you can put in place today. If you remember only one thing, let it be this: A little bit of organization now will save you a massive amount of time, money, anxiety. Building a simple system for your finances is not a chore. It is one of the most profitable activities you can engage in as a business owner. It is the foundation of a resilient, successful enterprise. Separating your accounts, tracking your expenses weekly, getting a professional review are not just about compliance. They are about taking control and building a richer life. Creating a separate business account, tracking every expense with an app, setting calendar reminders for deadlines, using contracts, claiming all your deductions, saving records to the cloud, getting a final review are the building blocks of financial clarity. They transform taxes from a source of fear into a predictable part of doing business. You are the boss. It is time to manage your money with the same passion and intelligence you bring to everything else. The power is in your hands, and it starts with a few simple strategic changes. Start with one habit this week and build from there. Your financial future is too important to be left to chance. Subscribe for more financial clarity with Resilient Boss.